Hello and welcome to this episode of Perspectives. My name is Chris Stegemann, and today I am joined by Robert Cohen. Robert, thank you for being here again.
All right, good to be here.
Last time Robert was on was last July, where you and I had a discussion surrounding public versus private credit, and you very astutely predicted that public and private credit returns would converge and that the alpha that was once there in private credit was dissipating. So I want to definitely touch on that, but given the uncertainty in the credit markets that we've seen with a few of these events, with Tricolor, First Brands, a few of the regional banks, do you see these events as representative of a more systemic problem in the credit markets or more just isolated events?
I think that these are isolated events. We are not on the precipice of some sort of cliff in the credit markets. I think people are used to an environment where the default rate is zero all the time. That's a little unusual. That happened for most of the QE or quantitative easing period when the Federal Reserve lowered rates to zero. But in normal credit markets, it's not unusual to have some defaults. In an environment where spreads are tight, which they are now across all credit products, it's not uncommon for lending standards to become more loose, which they are now. And so in that environment, you see lenders making mistakes where they're investing in credits with maybe insufficient due diligence, or maybe they're stretching a little bit. And I think First Brands, Tricolor, and some of these other examples that are out there in the press are really just illustrative of loose lending standards.
Yeah, and I think First Brands, I mean, they came to market. We looked at it a few times, right? But decided to pass.
Yeah, luckily, I mean, I can't say we're going to get everyone right, but we got this one right. So First Brands was auto parts supplier. It's a difficult segment, even if you have a credit that's a strong performer. It's just a challenging segment of the economy. On top of that, the underwriting standards in terms of disclosures were quite light. And so when we were reviewing the credit materials, we sort of unearthed more questions than answers. We didn't know necessarily there was fraud involved, but we certainly thought that there was a lot of extra due diligence we would have to do to even kind of understand the credit. And given the setup of a weak sector, we decided it wasn't worth our time. Just sticking to a kind of a traditional bottoms-up credit process, it just got screened out from kind of a high level, knowing that there wasn't the right information that we needed to make an intelligent credit decision.
I guess just taking a step back, state of credit. So these events you do not see as indicative of a systemic problem,
Right.
But just more generally, thoughts on credit markets right now?
Yeah, it's a mixed bag. So we have an undersupplied market, meaning that there's more demand for credit than there actually are loans and bonds available, because the credit creation has been quite anemic since the pandemic. And so in that environment, when you have undersupplied environments, you have tight credit spreads, which we see. And because of that, you get some weak credits creeping into the market. And we've seen underlying weakness in certain sectors, partly because of the weak credit standards, but also just because the performance of the US economy is uneven. So for example, we see weakness in the housing market. That's been the case for quite some time, really since the pandemic, hasn't really recovered. We're seeing weakness in other cyclical sectors like chemicals and industrials, as the economy is, like I said, not humming along evenly across all sectors. So we're seeing some cracks there. Of course, there are other sectors that are quite strong. We know that technology is doing quite well. There's an artificial intelligence boom that's causing a lot of strength in some parts of the equity markets, particularly the S&P and the NASDAQ are doing quite well, driven mainly because of AI. But back to the credit markets, overall, earnings are still strong. So if you have earnings growth more than anything else, credit will do well. We still see strong earnings growth in the credit markets. We see low default rates. So default rates indicate weakness in the economy, in the credit markets. And then downgrades are another thing to look at. So we still see more upgrades than downgrades. It's sort of decelerating, but until we see a wave of downgrades, we're not seeing really confirming signals of weakness. On top of that, if you look from a macro perspective, we expect the Fed to cut rates. We have deficit spending in the US, likely to have more deregulation. These are all contributing to what would be supportive for credit growth. A couple other things to think about is that M&A is usually associated with late cycles in the credit markets. We've been below trend in terms of M&A activity, really again since the pandemic. And so my expectation is that we'll start to see that pick up, credit creation pick up, and that'll be supportive of credit through 2026, and then we'll have maybe other things to evaluate. But where we are right now, I think that the credit markets are in reasonably good shape. I also point out that you should worry about credit when you're going to recession. That's when you have losses. As long as we have positive growth, I think credit will be just fine. And credit can actually hold up better than equities. Credit in a low growth environment will do fine. In a low growth environment, companies are still generating earnings and cash flows and they can service their debt. It's when that growth starts to trail off and go negative that you have to worry about credit losses. So that would be my overall assessment of things.
Okay. Yeah, we hear credit bubble from time to time, and it sounds like your point of view right now is things are looking pretty good. Any comments on just that idea of a credit bubble?
Yeah, well, credit bubble, visually you think of something expanding, but if you look at credit creation, credit as a percentage of GDP has actually been declining since 2020. So if you had a visual, you would actually have the bubble shrinking because the size of the credit markets have not been growing. They've been going the opposite direction. The place where credit has been growing has been in private credit.
Right.
And so if anything, you could say that the public credit markets have been transferring their risk to private credit, which is positive for the public credit markets because they're de-risking. So I would say in the public markets, you can't have a bubble until you start inflating the bubble.
Yeah.
And we're not there. If we might just be in the very early stages of starting to fill the bubble again. That takes time. You need to fully inflate before the bubble pops. So no bubble in credit at the moment.
Okay. Yeah, I think that dovetails very nicely to that public versus private debate. As I said, kudos to you for an astute prediction last time you were on the show. So I think everyone is aware of the liquidity differences with private and public, but if you were speaking to an investor, what are a few of the main differences that you would want them to be aware of when you're assessing the two?
I think we have to review what was the opportunity in the past that I think has went away. So there was alpha. There was an opportunity to really outperform in private credit during the pandemic, and just thereafter, so 2020, 2021, 2022. That was an environment where the capital markets were either completely shut down or only partially open. So there were many credits that couldn't access the public markets, and so private credit could fill a lending vacuum. And in that environment, they were able to achieve much higher yields, have very strong terms, and they really were very interesting opportunities. But once the credit markets started to open up in 2023, 2024, and of course in 2025, fully open credit markets just refinanced all of those opportunities. And so what was left was weaker credits. And so where we stand today, private credit as sort of an asset class is mostly a weak single B trade. So most of the private credit market is B3, B minus. So the weakest single B before you become triple C. That's about 80% of the private credit market. If you look at, for example, the bank loan market, the broadly syndicated bank loan market, B3s are about 20-21%. So much lower exposure in the public markets than the private. So you have a much higher percentage of B3 credits. You also have more industry and borrower concentration. So for example, on average, a private credit fund can have as much as 30 or even 35% in just technology, software and information technology. Again, the bank loan sector, the broadly syndicated loan market has about 15-16% exposure to software and technology, so less than half. So much more concentrated in that one technology sector. If you look again in the bank loan market where the highest level of stress is, and we measure stress in terms of loans trading below 80, again, software and technology is the space that has the largest amount of stress.
And can that be translated over that idea? Okay, here's a sector. This is the sector where the most loans are trading below 80. It's public. In the public loan market, can you take that thinking and kind of apply it to the private markets?
Yeah, I mean, it's an indication of the overall sector health. Now, of course, credit selection is important. Not everyone has the same percentages that I'm talking at an asset class or index level,
Right.
and so different funds will have different composition. But yes, just looking at the overall sector and industry, the way it's operating, I think that you can translate some of these observations back and forth. And don't forget, a lot of the credits that are in private credit came from the public markets. So they're the same names that are bouncing back and forth. Many credits started as a public issuer in the bank loan and high yield market, and then were refinanced into the private credit markets, and many are coming back into the public markets. Another thing on top of just the stats that I mentioned is deal flow. So the private credit markets have been losing share recently to the public markets because rates are so competitive in the public markets. You can refinance and cut your borrowing costs. So if you're a borrower and there's a source of financing that's cheaper than your current financing, why not go to that?
Well, what's the answer? Why would a borrower not go to it?
The reason that a borrower wouldn't go to the public markets is because they need more flexibility, because they have operational concerns or financial concerns. And so they want a lender that's going to give them flexibility in terms of covenant terms or just general ability to amend the transaction if they get into trouble. So if you felt confident in your operating performance and your financial performance, and you knew you could service your debt load, I think you would just go with the cheapest cost of financing. You need that flexibility, or you pay for that flexibility because you think you need it. And that's fine. It's sort of a different trade. That's more of an opportunistic or stress trade. And then you can decide whether the timing is right for that. But clearly you can objectively see that these credits are have lower ratings, and they're more concentrated in very specific industries. So that's just an objective point of view.
If you're looking at, let's call it the loan market versus the private credit market, private credit, they're different trades, as you've said, not necessarily good or bad, but as we speak today, private credit is lower credit quality, has higher concentration via sector. I think we're all aware, and is less liquid. Not to say that there's not good opportunity there, but as long as investors are aware of those things when assessing, I think that's very important.
If we want to talk about predictions for 2026, just to shift gears for a minute.
Yeah, we'd love it. See if you can go 2 for 2 here.
Yeah, so I mean, my outlook for 2026 it assumes that growth will still hold up, that we will have real GDP that's positive. And in that environment, that is supportive of credit. I think in that environment, we'll see a pickup of M&A, we'll see more AI transactions, and we'll see risks grow into 2026, maybe into 2027. And that's more typical of the setup that puts you at risk for something bad happening. Usually you need time for the credit markets, and when I'm talking about really what we should be talking about is credit creation overall, to kick into gear and companies start to lever up. And as they lever up, they become more risky, and then there's a stress in the economy that causes it all to kind of unwind. So I was talking about how credit creation has been negative. I've been talking about how M&A has been below trend. Leverage buyouts there hasn't been much of any. There's been a couple announcements. Electronic Arts is being acquired. There's been a few other, but really just a couple. We haven't heard about a big boom. So I think 2026 is more going to be the year where you start to have to worry about things, where you have this boom of artificial intelligence, capacity build out, you have a boom in M&A transactions, large LBOs, and then just more broadly, you'll start to see credit quality deteriorate. Instead of, for example, investment grade has been moving up in credit quality, maybe we see investment grade metrics start to move down in credit quality. High yield has been moving up in credit quality from single B to double B. Maybe high yield starts moving back down from double B to single B. Maybe we start to see, instead of upgrades outpacing downgrades, we see downgrades, more downgrades, so downgrades outpacing upgrades. Those are when you start to worry. When you see credit growth, again, talking about the bubble, visually we see the size of the credit markets growing, so that sort of visually looks like a bubble being filled, and we see these headline deals of more risk, lower credit rating. I think that's going to be the story for 2026, and that's when we have to start going from maybe green to yellow to red flag in terms of we need to be watching out here. There's something going on.
Great. Well, thank you for that. I think it makes sense. You know, your macro, there's no credit bubble, but you're not being compensated for going down in credit quality like maybe you should be. So migrating up in quality gradually, but still participating in the credit markets.
Yeah.
So, well, we covered a lot today, Robert. appreciate you being on. And if
My
anyone
pleasure.
would like to reach out to their DoubleLine sales representative, feel free to check out our website, which is doubleline.com/contact us, or you can reach out to fundinfo@doubleline.com. Thanks again, Robert.